You guys just went through parts 1 and 2 of the Etsy series on this channel. And really, you're still not satisfied? You've come back for part 3? I'm kidding, guys. I hope you got some real value from both parts 1 and 2. And now, let's get to the most actionable part of this series, which can help you make a real investment decision in this company. So what exactly should you be thinking about when valuing Etsy? Well, you come to the right place because in this video, we're going to be covering the top 5 things that you should be considering when valuing Etsy. So let's jump right into the video, guys. You're watching More Money. Let's get it. What's up, everyone? Thanks so much for tuning in. I'm Tay, and you're watching the #1 channel on YouTube for people that want to retire early. You guys are watching part 3 of our 3-part series on Etsy. In part 1, we went over the business model and the drivers of growth for the business. In part 2, we covered how exactly Etsy earns their revenues, and we also covered a threat that the business is starting to experience and reviewed their financial statements. In part 3, this video, I'm going to be covering that free downloadable model on Etsy that I provided for you guys by covering the top 5 things that you should be considering when you model out Etsy. And guys, don't forget, unlike many of the other channels on YouTube, I've made my valuation model on Etsy free and fully downloadable, which you can grab from the description below. So guys, as we get going, please consider smashing that like button. It really helps YouTube know that this channel provides valuable content, and thus they'll share it with more viewers like you. And to be honest, I'm absolutely loving the community here. We got almost 900 strong of extremely intelligent people, so let's just keep this thing growing. Now, the first of 5 things that you got to consider is how do we forecast the growth of the revenues for Etsy? I'm growing marketplace and services revenue as a percentage of Etsy's platform's gross merchandise sales, or their GMS. The reason why I'm doing this should probably be obvious to you, but just in case if it isn't, it's really just because if their vendors are not selling products on the platform, Etsy will not be making any money. So that whole revenue model is driven based on that GMS figure. So if you forecast out revenues as a percentage of the GMS, we'll stay true to that relationship. And you'll see that although historically they have been expanding that GMS as a percentage of revenue, in my model, I'm not expanding that in my base case scenario. And this is largely being done because I'm notoriously conservative in my modeling. Over the last 20 years or so, I've seen way too many businesses run into hard times. The other thing that I want to point out is that when it comes to forecasting out the growth of Etsy's GMS, I'm following industry growth expectations. US e-commerce retail is expected to grow in the lower double digits, so I'm growing Etsy's GMS in that range. But note, guys, that they absolutely can end up growing it much faster over the next 5 years, especially if they have a blowout 2021, which is looking like what they're going to have. So to me, the way that I'm modeling it right now, any extra growth is largely going to be an upside. Now, before you go in and change the expectations that I've built in, the one thing that I would caution you about is to be careful to not forecast out the current short-term success that the company is experiencing over an unrealistic longer term. This is an area where I absolutely try to be conservative in. Now, the second of 5 areas that I want to point out is when you forecast operating expenses. You'll notice that I'm forecasting operating expenses largely as a percentage of total revenues. For cost of revenues, I'm running at approximately 27.5% in my base case, despite them achieving 27% in 2020. So what I'm really doing here is giving them a little bit of wiggle room to increase their costs by 0.5 percentage point should they need to, and it not disrupt my valuation model. Also note, guys, that scale will likely bring this down, so don't be surprised if it's lower than 27% in the future. It's been trending down over the last couple of years. Now, marketing is a controllable expense, and I largely think that it'll approximately be 25% of revenues as they continue to grow out that business. With product development, from slide 28 of their 2021 presentation, it looks like they are loosely targeting 10% here. I'll forecast that and see if I can get more information from here. Historically, it has been higher as a percentage of revenues, but I would expect it to decline with scale. Now, speaking of declining with scale, G&A is expected to do the same thing, but I'm forecasting it at approximately 9%. Don't be surprised if this drops down to 5 or 6% in the future. I'm just really being conservative here. That's really what's happening. And other than interest expense, I'm not forecasting the other line items. Feel free to do so for your models. Now, the third item of the 5 items that I want you to look out for is forecasting taxes. I'm forecasting taxes at the US statutory tax rate of 21%. They haven't yet paid a tax rate this high, as they have had tax credits. So my rate might be high, so adjust this as you see fit. I'll be a bit conservative here and use the statutory rate. I know that they'll eventually be paying near that 21%, but I also feel that if future administrations may also increase the corporate tax rates. So my forecasted tax rate of 21% might actually even be a little bit low when you think of it from that perspective. So let's leave it at 21% and we'll see what happens from there. Now guys, items 4 and 5 of the 5 items that I want you to look at deal with the 2 different valuation metrics for Etsy, and I believe that these are the most important things to look at. But first, if you received any value from this video thus far, please smash that like button. It really helps YouTube know that I'm providing valuable content, and thus it'll help grow the channel by sharing it with more viewers like you. Also, don't miss out on a future deep dive that is coming out very soon on Shopify. I'll be doing a deep dive as well as providing you once again with a free, fully downloadable model, as I always do. And of course, you guys already know I'm going to walk you through the whole thing. And in order to not miss out on that video, please consider subscribing to the channel and hitting that notification bell to be notified when I upload that video. Okay guys, let's jump right into the valuation models. You'll notice that I have 2 models. One is for EPS and the other one, the second one, is a free cash flow per share model. With the EPS model, note that I'm diluting the shares at 0.5% of the share base each year. This reflects that there is a dilution issue, albeit slowing. The company is trading at a high multiple right now at over 60 times earnings, and my valuation largely forecasts that that multiple is expected to decline over the next 5 years. I think 22.5 times earnings is reasonable, if not on the conservative side. So adjust this as you wish. I'm using a discount rate of 11.5%. I'm not giving them any credit for their cash on hand as accretive cash to the valuation, as they do have debt. Note that the debt is convertible, so you do have some complexities in forecasting here. I just kept it simple and netted the 2 out. You guys might think this is a bit too simple, but this is just how I think of businesses. They have approximately $3.50 per share in short-term investments, and cash accretion amounts to about $14 a share. So overall, my EPS valuation is suggesting that the company is worth approximately $100 a share. Now with Etsy, they have depreciation and share-based compensation, which is muddying the waters with an EPS valuation. So this moves us into our 5th item of the 5 items to look out for. I have taken that into account by building a free cash flow per share valuation model, which I believe is the best for Etsy. The reason why I believe this is the best is because they've had large upfront capital costs, but they are largely running a capital light business model now. Now, as you can see from the model, although the free cash flows have been running at approximately 200% of net income, I do believe that it will eventually converge with net income over time. So guys, I'm forecasting free cash flow as a percentage of net income at approximately 135%. Change that as you wish. And also, as with the EPS valuation, I'm doing the same with the free cash flow per share valuation, where I'm discounting at 11.5%, which gives them a valuation of $143 a share, which I think is the more appropriate valuation for Etsy. Now guys, that's it for the 5 things that you should be aware of when modeling out Etsy. If I missed anything, please let me know in the comments below. Also guys, thank you very much for tuning into this 3-part series on Etsy. I'll see you guys later.